you are famous for your predictions on all aspects of the economy. We've got a chart up now that says QE, quantitative easing, creates Frankenstein, markets on crack, 120% overvalued, and then it says births are lagged for peak spending versus the real Dow Jones Industrial Average. I was actually talking about this on my show just yesterday about how births need to be lagged. So, for example, you talk about the peak spending time and the peak earning time in people's
Yes.
career. And so you can't say, well, there's a lot of people being born today. You need to
Yeah.
look back, what, 46 years, right?
Yeah, yeah. Kids are a liability. Kids cost. Kids growing up cause inflation, especially as they enter the workforce, and businesses have to invest after governments and education and parents raising them. What's key is people spend money dramatically higher from workforce entry, age 20 on average, into 46 for the boomers. It's now 47 for the millennials, now more driving the economy increasingly, and it looks like to be about 48 for the zillennials to follow. So yeah, this was my first breakthrough indicator, Jason, back in the late 80s when I saw how big this boom was going to be because the baby boom was so giant. It just moving forward, the birth index adjusted for immigration, which I can also do accurately for the peak spending of the average person household, and it tells you when the economy is going to boom and bust. It called everything perfectly. I mean, again, this indicator I came up in 1988. I said this boom's going to peak by the end of 2007, and it did, and we've been living on quantitative easing ever since after the baby boomers slowed down in their spending.
Right.
The next generation doesn't come along till about 2023, the millennials.
Okay.
And this shows how much the market's been overvalued
All right.
simply because of quantitative easing.
Slow down for a second. Okay, I want to just get some foundational things, make sure the listeners and viewers understand them. So, first of all, what is the age of someone's peak earning power and peak spending? What are those two? They're about the same, right? They're not
They're
too far off.
about the same. It was 46 for the baby boomers. It's
46 years old.
47 today for the millennials. And when I look at in the past in Europe and Australia and other markets I deal with, most other places it's about 47.
Okay, so and is that peak spending and earning, or are they
Peak
slightly different?
spending. Well, the spending is what matters to the economy because people, as they get a little older, they save more. The spending is the critical factor. The earnings peak close to that, but the spending is what correlates with the markets the most.
Okay, great. So 46 years old for the baby boomers, the millennials, they're a year behind, and
Yeah,
it's 47.
47. Now
Okay,
that's built into this lag. So the lag is naturally extended to 47 as we switch to millennials in this chart going
Okay,
forward.
now you also mentioned zillennials, and I haven't heard
Yeah.
anyone refer to it that way, but that's Generation Z, right?
Yes.
Okay, so understanding these demographic cohorts is very important. As I've said many times, baby boomers, depending on who you ask, about 76 million Americans, millennials, about 80 million Americans, my generation in between the two, tiny little generation, about 46 million, I guess, Gen
Yes,
X is
Gen
me.
X. That's the downs. That's the
Right.
lower birth generation,
Yeah.
which had caused the downturn after 2007.
Well, sorry about that, folks.
Yeah.
Yes, I'm in this little lonely generation with
Well, you're the
about
lucky
half as
ones
many
because you get
people.
to buy everything at the bottom. You get,
Okay.
so you're actually, it's an advantage. My father was in the smaller generation, born in the early 30s,
Mhm.
before the baby boom. Every house, everything he bought always went up
Oh,
because the baby
that's
boomers drove him
interesting.
up coming after him.
Yeah, that's
So the
interesting. Yeah,
millennials
yeah,
will
yeah.
drive up things for the Xers,
Oh, yeah, okay,
especially,
interesting. That's
especially
an
real estate.
interesting idea. Yeah, definitely. Okay, so what does this chart tell us? So really we've been living on quantitative easing coming out of the Great Recession, which means effectively, the easing of the money supply, the increase in the money supply. Part of it is, money creation, money printing, as they say. It's not really printed much nowadays. But what does that mean? I mean, what tell us what that means.
Okay, real quickly, this is very important. It's not actually a substantial increase in the money supply. Normally, what the central banks have done in the past, they lower interest rates, they make money more available, they do expand the money supply and create more reserves for banks, so banks will tend to lend money. What happened with the Federal Reserve when we came into the Great Recession is they didn't realize consumers and businesses had already overborrowed, overbought housing, overexpanded businesses and capacity. They didn't need to borrow, and of course, banks tightened up. So that didn't work. What ended up happening is the Federal Reserve ended up doing quantitative easing rather than just reserves and lower rates. Quantitative easing is not putting money into the bank system and lending. It is literally buying financial assets like bonds, which puts more money into the pool that's actually chasing financial assets, and that drives up financial assets. So what this chart is showing, while the economy kept slowing, and you got to remember, this is the slowest recovery in all of history, 2% average real growth versus 4 or 5% or more in past recoveries. And that's with $16 trillion printed by central banks. But the money did not go into the banking system, did not go into consumer lending, which does expand the money supply. We got, and this is why the gold bugs were wrong. We did not get an inflation surge or hyperinflation. What we have is the greatest financial asset bubble in history, greater than the roaring 20s. And the stock market, I mean, it's true of real estate. Real estate's gone up, everything else too. Bonds are in a bubble, but real estate is the strongest bubble and where it benefits the most from low interest rates, more money chasing financial assets. And so what this thing has showed, this blue line in the background shows where the economy should be, and stocks normally follow that, adjusted for inflation. But even with this weak recovery, which would have been worse than weak, it would have been a down economy without all this stimulus, stocks have gone straight up like it's the best economy in history, and they now are 120% overvalued. And I'll show let me show one more chart. That 120% difference is the difference between the black line here, which is earnings per share of stock, versus the blue line, which is total corporate earnings, which came back up after a recession, strong stimulus, and they've hardly grown since. Earnings per share have been grown because companies are buying back their stocks. The third chart, 5.6 trillion. Remember, the Fed printed about 3.7 trillion. Central banks around the world about 16 trillion total. 3.7 was printed, 5.6 trillion because of the low long-term rates and the flush money in the economy. 5.6 trillion have gone to buying stocks back, shrinks the number of shares, which greatly leverages the earnings per share and therefore the stock price. So this is an artificial bubble in stocks that has nothing to do with the economy, which the blue line shows you where it should be.